Hello, everyone, and welcome. My name is Nicola Corzine, and I'm the Executive Director of the Nasdaq Entrepreneurial Center. I think today may be the very last time that I get to come out and say Happy New Year. We hope that you had an incredible holiday season and at least managed to get a little bit of R&R into your systems during this time as well. We have a great session ahead of us today. We're going to be talking venture finance trends with some incredible individuals that are knowledge experts in this space. We've got Wilson Sonsini back with us again, leading the conversation. I'm joined by Maveron as well as Ascend.vc, just incredible experts. Now, before we get started, I've got a couple of housekeeping things I want to go through. First and foremost, mentorship. You know how much it means to us as entrepreneurs, to each and every one of you. We are committed to it in 2022, just like we have been for the last 7 years. And as you may have seen in the chat and in the opening video, we're doing a big campaign around this. We have a new platform, open, accessible mentorship globally, worldwide for everyone. Over 1,400 mentors and mentees in the platform. If you have not yet signed up for it, if you have questions that you want to answer, if you have people that you need to connect with to do the businesses that inspire us each and every day, please take a moment, get in that platform, sign up. And if you have capacity to give back, both as an entrepreneur who's probably learned more than one or two things along the way, or as an incredible investor, supporter, champions of entrepreneurs, we'd love to invite you into the system. Please do take a moment, take time to sign up, pay it forward, just like the center is built on. And speaking of pay it forward, none of the work of what the center does each and every day as a nonprofit is possible without our incredible sponsors, our incredible champions and believers in our work. To each and every one of them, we say thank you. Really, it makes a difference. And your work has now contributed to our ability to have provided more than 50,000 entrepreneurs with free education. We so appreciate all the belief that you have in the importance of this work. Now, during these unique times, we have been tracking how our entrepreneurs are doing above all else. The last couple of years have been a journey, to say the least. So we do want to take a moment, just like we do every single time we get everyone together, and ask and check in with you. How are you doing right now? I'm going to go ahead and launch a quick poll. Just take a moment, if you will, to share with us how you're doing. Are you entering this market right now with a healthy dose of optimism? We always see a little bit of that, obviously, with our entrepreneurs, but also we know that it has been a rocky journey. And so this information helps guide us on the importance of prioritizing things like wellness for our founders. As you may have seen last year, we finished the year with an incredible session with Malika Chopra. We actually have Deepak Chopra, who's going to be joining us shortly in the coming months. So we want to prioritize your health and your wellness. You are in this as a marathon, as a founder, and we're here for you. So thank you for sharing how you're doing. I'm going to end that poll, share the results. As always, you are not alone in this journey, and you're seeing a number of founders reflect that too. Finally, most importantly, this conversation, while we're going to be shaping it with some pre-submitted questions and some really good insights, we are also wanting to hear directly from you. So please use that Q&A function that you'll see at the bottom of your screen as you're inspired, as you have questions. If you have anything that's top of mind that you want to ask our experts today, we want to hear from you. Use that. All right, now without any further ado, let's check in with how the state of the state is going around our venture finance trends. It's my absolute pleasure and delight to welcome back Craig Sherman, our incredible partner at Wilson Sonsini, to share his insights from the Entrepreneurs Report. Craig, over to you.
Great. Well, thanks, Nicholas. Great to see everybody. I'll also wish everybody a Happy New Year, because I believe January 14th is the official last day that we're allowed to say Happy New Year. So it's great to see all of you remote, some of you for the first time, I suspect some again, since we've been doing these for a while. Our firm tracks data on a quarterly basis on venture capital activity, and we report those data in an entrepreneur report. I'm going to talk today and show you on the screen the numbers from the third quarter of 2021. The Q4 numbers we're still finalizing, since a lot of deals closed on the last couple of days of December. We're still tallying the final numbers, and in about a month or so, we'll be coming out with the final numbers for Q4. And as I go through these 4 slides, I'll speak a little bit about, anecdotally, what I expect that we will see for Q4. Spoiler alert, it will be pretty much the same as what we've been seeing for a while here. This slide is probably one of the most interesting slides. The up and down rounds by quarter, looking back over the last 5 years. An up round, for those of you not familiar with the jargon, is a financing at a higher price per share than the last round. A down round is the opposite, of course, a financing below the price per share of the last round. And a flat round, here the black line, is basically, it's an extension or a reopening of the last round, or a new round with a different name, but it's at the same price per share as the prior financing. And when you look at these trends here, you can see, and perhaps not astonishingly for those who read the newspaper, that most financings, well over 90% of financings in 2021 were up round financings. And you can see up and down movement here over the last 5 years. You can see that 5 years ago in 2016, only 80% of financings were up rounds. So there were far more down rounds and flat rounds 5 years ago. If we took this chart back 20 years, and I'm going to talk to our team to see whether we can do that for the next quarter, you would see a lot more variation, not surprisingly. And if you looked at the period after the market crashed in 2001, you would see that a majority of financings were down rounds. And again, in 2008, when the financial markets crashed, the public market downturn spilled over into the private markets as well. And we also saw a significant number of down rounds. But since the recovery in 2008, we've been living in a blissful period where most financings for venture capital backed companies have been up rounds. Why don't we jump ISIS to the next slide? And here's the eye-popping numbers of pre-money valuations for seed financings, of course the lowest bar, the earliest stage financings, Series A financings other than angel financings, which we include in the seed financings, and then Series B financings in light red, and Series C and later financings in dark red. You can see that valuations have been going up and up and up. Q3, actually, in late stage financings in our data, there was a significant decline, although still by historic standards, very, very high pre-money valuations. And in Q4, I think we're going to be closer, not necessarily in record numbers like Q1 and Q2, but we're going to be closer to Q1 and Q2 with valuations very high. We'll talk with the panelists later on in this conversation about expectations going forward, but there's no question when you look at these numbers, it is a very steep up and to the right curve of valuations at every stage, but particularly later stage is going up. When you look at seed financings, in full year 2016, we're at 5.8 million pre-money valuations for the earliest financings. And this year, we're likely to end up over 10 million. So in 5 years, we've more than doubled. But when you look at later stage financings, the increases have been even greater, where late stage Series C and later financings in 2016 were the average pre-money valuation was 179.8 million, and undoubtedly we're going to finish 2022 well over 500 million. So it's going to be a 6 or 7x increase in late stage valuations compared to about a 2x increase in the earliest stage financings. Isis, why don't we jump to the next one? Okay, so this is the median amount raised, and the median amount raised, you can see here, has been going up steadily, and particularly starting in Q4 of 2020, the size of the check has grown meaningfully, particularly, again, in the late stage financings. And there's just an immense pool of capital available for these late stage rounds. I'll talk a little bit more about that in a second. Why don't we jump to the last slide here for bridge financing. So a bridge loan is a financing that's constructed either as a convertible note or a SAFE. I'm sure many of you are familiar with essentially the same thing, but it's a financing intended to get a company from one priced equity round to the next priced equity round. Again, steady level of activity and relatively large dollar amounts for bridge loan financings. So that's it for our data through Q3. Again, I said we'll come out with the data for next year. There were a couple more numbers I wanted to throw out here that I just saw from CB Insights that they published yesterday on the extraordinary level of activity. So they reported that the number of unicorns, so private companies with a valuation over $1 billion, increased 69% year over year from the end of 2020 to the end of 2021. So there are now nearly 1,000 unicorns, and there are 44 decacorns, 44 private companies with a valuation north of $10 billion. The amount of money invested globally in venture capital-backed companies was $621 billion, which was more than double the record of the prior year, which was under $300 billion. And there were I talked about those late stage rounds and all the capital coming in. Most of this growth has been in the later stage rounds, and that's where the valuations have really been jumping and the amount being invested has really increased in those late stage rounds. There were 1,556 financings for private companies worldwide over $100 million, raising over $100 million. And the previous year's record for 2020 was 630. So the number of financings over $100 million for private companies more than tripled year over year. So again, extraordinary great activity, and we'll talk as we continue the conversation here about what we expect to see this year.
Oh my goodness, Craig. It always feels like every time you present, I'm like, is that even possible? And here we go again. So thank you for those incredible statistics, for some of that grounding information that is going to be used as our foundation for the conversation. And speaking of which, let's get to it. So joining us today, we have Anarghya. She's a partner at Maveron, incredible fund. We are also so very lucky to have Kirby joining us. Kirby is the founding general partner at Ascend.vc. Rather than do injustice to the incredible backgrounds that both of them have, I'm going to invite each of them to take maybe 30 seconds to share a little bit about you and, of course, your fund. Anarghya, can we start with you?
Yeah, absolutely. Hello, everybody. Good morning, I guess, if you're still on Pacific. It's great to meet you all. My name is Anarghya Vardana. I'm a general partner at Maveron. I'm based in the Bay Area, and we have nice sunny skies today. It's a little chilly. And Maveron is a consumer-only fund. We invest in direct-to-consumer businesses. That's very broad for us, everything from health tech, e-commerce, social apps, fintech. And Maveron has been around for over 20 years. We've invested in some of the OG.com businesses like eBay, Groupon, and some of our more recent investments are companies like Allbirds, Everlane, General Assembly, Imperfect Foods, and more. I spend a bunch of time in the consumer healthcare space, about 80% of my time. And within that, invest pretty broadly, everything from mental health, women's health and reproductive health, children's health, and more. And really excited to be here with you today to share a little bit more about the venture capital and entrepreneurial journey and hopefully shed some light on what can sometimes feel like a very opaque space. Thanks for having me.
Well, thanks for being here so much. Kirby, over to you.
Yeah, hi. Thanks for having me. I'm excited to join in and learn a little bit too, hopefully. But yeah, I did 20 years of startups as an operator, starting in 1996. The first two we took public. The second two raised venture and sold to public company acquirers. And after about 20 years of doing startups, kind of realized maybe the thing I was best at was picking the right teams and times and markets to bet on. And so rather than doing that, with my entire life for these 5-year sprints, I thought spreading it around and supporting, a number of founders was a better way to attack the market. And so switched over to the other side and raised a fund in 2019. And now we're investing out of our second fund at Ascend.vc. It's me, solo capitalist here. It's old habits die hard from being a founder. You would never say I as a founder.
That's right.
But I invested in 49 companies out of the first fund. Typical check size, 250 to 500. We are idea stage investors. So very much, the terminology shifts. It seems every couple of years, pre-seed, idea stage, but we want to be the first check into founders' journeys, and we do that primarily in 4 areas. So AI, ML, SaaS, PaaS, marketplace, and e-commerce. And we are initially focused on the Pacific Northwest and maybe the Great West as we do more funds and expand a little bit more with our aperture.
Amazing. Well, between all of the expertise and experience here, we're going to have such a good conversation today. I'm excited to get started. The last time we got the band together, Craig, we were saying, oh, the world's returning to more normal. And it certainly seemed like the report, the Entrepreneurs Report at the time was indicating that. I know we haven't come out with the last one, the fourth quarter yet, but the last couple of months, you know, it's been an interesting one, to say the least, in the world at large. What, if anything, have you sort of seen thematically maybe that has shifted in the last couple of months, either around, you know, deals, obviously the timing to close, all those types of important areas? There is always that seasonality weirdness that can often pop up around this time of the year. Anything that sort of is top of mind coming into this conversation as we look at the last couple of months of information?
Yeah, as you know, looking at the data coming in for Q4, it looks like it was a continuation of the year as a whole, which was very high valuations, very large financings to continue to come through, very rapid time from first meeting to close. So we've had very many clients, particularly later stage, raising large amounts of money, where going from first meeting to term sheet signing could take place in a couple of weeks, which is extraordinary. And then signing a term sheet to closing could take place in 2 weeks, 3 weeks with minimal due diligence. And again, these are signs of peak market. These are the kinds of things where things are moving more quickly and we're at very high valuations and people want to get deals done. Now, January so far has been slower. There are term sheets showing up. I think it'll be interesting to speak to Anargya and Kirby about their perspectives on this, but yeah, there's always seasonality. It always takes some time after the holiday. You know, nobody's putting a term sheet out for a new financing between Christmas and New Year's, of course, and nobody's putting out a term sheet for a financing the first week of January. Although I actually had 2 clients sign term sheets for financings in the last 10 days. So there is some level of activity, and there's always that pause. And I think the question is whether it's going to slow down a little bit more so that we aren't going to have the same level of frantic activity that we saw throughout all of last year, or whether this is just, you know, the normal seasonal pause for the beginning of the year, and we're just going to ramp back up to where we left off with $100, $200 million checks being dropped right and left.
That is going to be the question. Well, speaking of, though, Anargya and Kirby, would love to know from both sides of the house, if you will, like, so for existing portfolio companies, maybe follow-on deals that you've been seeing in the last couple of months, any anomalies, any changes or shifts in behavior, and then equally new financings that are coming in. How is that working for you? How's the deal flow looking? What is the general appetite? Kirby, maybe I'll start with you, since you are our first check writer in. What's been going on as first check writer in?
Yeah, you know, it's interesting, being that we're not a Bay Area firm, and being that that we are focused on, idea stage capital. I always tell people it's kind of like, for founders at that earliest stage, all of this is kind of like it's kind of like being 20 feet under the surface of the ocean in a hurricane. So, all of the noise, all of the valuation fluctuation, all of the speed to close, it exists, but it's maybe less pronounced at the very, very earliest stage. And so we're still getting to know founders before they've actually incorporated. And I think in those situations, there's been a pretty consistent sort of cadence in terms of, new founders popping up. I mean, certainly the later stage valuations, what I've seen actually impact founder velocity is with these companies getting so valuable so quickly, and many times allowing early employees to do secondary. You have founders now spinning out of hot startups at 3 years after they start and creating their own companies. And I think, historically, especially in Seattle, Microsoft people would stay for 20 years, Amazon people would stay for 10 years. Now you got people coming out of this next crop of, decacorns and unicorns in town that, they take it from Series A to Series C and they're ready to go do it themselves. And so that's something that we've seen more and more of, just sort of, on a year-over-year basis. But and so recently, I think things have just been consistent. I haven't seen anything slow down. I think I sent out a term sheet for I didn't realize I did it, but I think I did it the night before Christmas, and I was around.
That's a very happy holiday gift, probably to the founder. I'm sure that was not a bad thing to get in their inbox.
I think I might have wired on Christmas Eve, Kirby. So I'm with you.
Nice.
Santa's coming with some cash this year.
Merry Christmas. That's so cool. Okay, Anargya, same question over to you. Maveron's got an incredible reputation in industry. What's been happening at the competition layer, both of new deals coming inbound and maybe equally within the portfolio that you're seeing as they continue to go upstream?
Yeah, I was going to offer maybe a little bit of a different perspective. So regionally, like we invest all over the country. I'm in particular right now looking at companies usually in Silicon Valley or New York, kind of in these two very hot, fast moving markets. As I mentioned, I signed a term sheet, I think on, December 20 something, I think closed and wired on Christmas Eve or something. And these processes are moving super fast. Like Kirby said, there's founders who have done this before. They're super savvy. They're super sophisticated. They run a tight process. They know exactly who they want to pitch and speak with. They know exactly, hey, here's a consumer investor who gets this, this, and this. I want to augment them with a healthcare investor. Let's go. Let's make it happen. And these kind of formulaic rounds are happening fast. And I think Zoom and this pandemic world has changed the pace in which we work. We don't have to wait for a Monday partner meeting for the founder to come in and have coffee and sit around the table. And while that's nice and creates a really, beautiful personal connection, we're doing partner pitches, all week long. It could be 6 p.m. if we need to do it. It could be 5 a.m. Pacific if we need to do it. And I think the other venture firms are doing the same, just because the process is moving quickly and the founder no longer has to, go up and down in South Park in San Francisco or whatever. And in terms of going into the new year with deals, basically what happened, at least, for me and for a bunch of my partners I can speak to, is there were companies that we were meeting that first or second week of December, or relationships we've had for a quarter or longer. And everyone said, hey, let's check back in January. And January comes. Last week was a crazy week. Founders are like, okay, I'm hitting the ground running. My process is beginning. I am accepting term sheets next Thursday. And so, we had a company come in and do a partner pitch this past Tuesday. So a few days ago, we offered a term sheet, I think yesterday, and that's a term sheet in the second week of January. And I have a company I'm bringing in this following Tuesday after MLK weekend, again, for another partner pitch. And so some of the relationships that we've had longevity are materializing into potential investments. And it feels like the next few weeks of the quarter are pretty much packed with the backlog of that. For our own portfolio companies, I get a lot of questions of, hey, the market is really hot. I don't need the money. Should I go out and raise? And or VCs are approaching people and saying, hey, I want to invest in you. And as Craig pointed out, we have these VC firms that have raised massive, war chests of money. They need to deploy capital. They're writing those $100, $200 million checks. And companies are certainly, benefiting from that. Of course, there's such a thing as too much capital, but if you're smart and run a tight process and don't get too distracted from running the business, you can go get that money. Just anecdotally, we had one of our own portfolio companies, I think, raise 2, maybe 3 rounds opportunistically. They got proactively approached in a 13-month period from late 2020 to early 2021. So that's where we are.
Wow. You know, the insights that you gave around the shift in the infrastructure or the process inside of the fund is really interesting. I mean, we talk about that interestingly at the IPO layer, where, you know, the roadshow has kind of forevermore been changed because of Zoom, but also realizing the opportunity stack of like having partner meetings much more fluidly, much more dynamically than used to be in that once a week environment. Really interesting. Okay, so all good signs, obviously, well, good signs, all very interesting and very promising signs, I would say, of activities that we've talked about so far. But obviously, there's also maybe some counterside elements to sort of look at. Craig, are there any elements that have shown up in the report or more recent statistics that are a little just interesting to lean into and maybe watch and to see if there's any cautionary tales that may be emerging on the horizon?
So I would say in the stats, we're not seeing any warning signs yet of impending doom. And I don't know that I would be a doomsayer, but I would look at the level of activity that we've been experiencing for a long period of time, and particularly at how quickly deals are getting done, which we talked about earlier, you know, getting from first meeting to term sheet and term sheet to closing in kind of record time. And that's very much what happened in late 1999, early 2000, before the market downturn. And so I'd say that velocity is typically a sign of a peak market. Now, there's no way of judging whether we're 2 days away from peak market, or 6 months away, or a year away, or 2 years away, 3 years away. It's one of those old stories about, you know, the clock, a broken clock is right twice a day. At some point, the market will turn down. This is not sustainable, but we're not seeing any signs in the numbers yet that the world is about to implode.
Yeah, interesting. I want to switch gears maybe a little bit to talk about some of the earlier stage funding needs and challenges. It came up in a previous conversation that we'd done on ER that, you know, first-time founders, especially unfortunately in the pandemic, still struggling to sort of figure out, how do I make connections? How do I make connections over Zoom? Like what and where do I even start that navigation? And it's, as you know, Anarghya, you pointed out perfectly, a little bit of an opaque industry on a good day, to say the least. So how have you been coaching founders? Maybe I'll throw this over to Kirby and to Anarghya for your considerations to start. How have you been coaching founders to really think about how you set up pitching, how you set up the funding process as a first-time founder, and how to really build these relationships and trust in this environment that we find ourselves in currently and still? Anarghya, do you want to start?
Yeah, and I think Omar Gutierrez had a good question in the chat, similar to that theme, which is, you know, in this world where everything is on the internet, how do you kind of get those introductions? And I think, Nicola, you're hitting it right, which is that in this in-person world, there was a different way to meet people. You could go to events, you could speak with people, and a lot of the networking that was happening, there was a way for new people to the space to jump in and be a part of that. And in the virtual world, that certainly changes the dynamics. It changes the dynamics for first-time founders, for underrepresented founders, founders of color. And how do we navigate that? I think a couple different things. The digital presence has become more important than ever. And we've seen that both on the VC side as well as the founder side. And that could look like everything from being a part of the Twitter conversation, blogging, podcasting, you know, Clubhouse took off a lot during the pandemic, and having your voice, your personal brand, your story heard on the internet. Of course, that's a lot noisier and much more vast than trying to do it in a room and doing it over an appetizer, but you know, that is where we are. And the warm intro has become even more important, which is, can you find your connections to get in front of that VC? Let's say you're trying to fundraise, to get that introduction. I tell founders to try all the different networks they might be a part of. It could be a university, it could be a professional organization, it could be a regional thing. Try and find those connections, because that's going to be the easiest way to have that conversation. And then try to, you know, attend things like this and get in front of people that you might need to speak with in order to raise that fundraising. And one of the best ways to do it is, let's say there's a VC who might be a perfect fit for your for your company, find them online, try to engage in that conversation with them online, respond to their tweets, respond thoughtfully to their blog posts or whatever it is, and capture their attention to then go from there.
Oh, so good. Such great advice. Thank you for that. Kirby, I'm going to lean in a little bit to ask you, but on the slight other side, meaning that, as you said, 20 plus years as an operator, raising money, you had to sort of figure this out over different types of markets as well. With that experience for first-time founders, what would you offer as expected advice on like how to navigate, how to figure this path out, if they should raise money, when they should raise money, who they should raise money from?
Yeah, it's going to be different for everyone. I think, the last startup that I did, I was fortunate that my co-founders were two guys who'd started a couple successful companies previously and had never taken venture. And so there was a little bit of like pent up demand. I always say, I actually, Anarghi, I got a check from Maveron, but it wasn't really for me. It was for my amazing co-founders.
Let's pretend it was for you, Kirby.
But I think in whether or not you have that situation, that's a fortunate one to be in. But what we did something that was really interesting. As we were building the company, we had a rule, and the rule was never talk about fundraising, except once every 3 months, we had an hour set aside to talk about fundraising. And that hour was a time for us to check in and try to understand, had we discovered something that was differentiated enough from the stuff that had come before, and were we the right people to be tackling that problem? And was the market going to pull us in such a way that we had a compelling opportunity? And if we thought that we did, then we would go raise money. And it took a year and a half before we did that. Now, again, these were founders who had been successful in the past. And so we had the luxury of bootstrapping. But I think you could compress that timeline. The point is, just be very mindful about your decisions around fundraising and when, and what's really inspiring you to want to raise venture, because it is its own very unique and specialized type of financing, and it's not for everybody, and that's okay. I always say our last outcome, we doubled investors' money, which in any other in like a year, which in any other any other category of capital would be like awesome, and in venture it's like disappointing. And so you need to kind of sign up for that. I think something, but in terms of like then actually navigating the financing world, if you're a first-time founder, let's say you're under networked. Certainly, I give an example. The last 4 deals I did, one was cold off Twitter. He reached out to me based on my Twitter account, and it's actually an incredible founder. The one before that was out of an accelerator. The one before that was referred by a co-investor that I trust, and the one before that was from a portfolio founder. And so, like, those are all different ways to get on the radar of an investor. And then, I think ideally, if you find that first check investor, and you're raising, less than $1 million, $500K, $250, it's almost as important, if not more important, to have that person be able to be a Sherpa for you on your venture journey than it is for them to write a huge check. Like, especially if you really don't know, if you haven't spent 5 to 7 years in a growth stage startup, or if you're not, from the knowledge economy, maybe you've been working in industry. It's critical to find someone credible to just help you understand the lay of the land and sort of navigate this world where now we have, 4,000 venture capital firms, I think. And finding that person's difficult, but if you can do it, much better than just knocking on doors and asking for cold intros.
Yeah, so good. So the Sherpa advice is what we talk about when it's like finding a value add investor. That's just what Kirby is talking about. It's like having someone who can pull you up right? It's finding not only the capital that's getting injected into the company with a strong belief and a strong Rolodex of power, but also someone that's going to guide and really be there beside you, figure out who's the right fit as the company continues to grow and the ways that you want to grow. Just love all of that. Nagia, on the flip side, you've spent an incredible amount of time in the world of product directly yourself. And I think that for a lot of our founders, when they're raising funds, it's with that lens towards needing to do something for their product, to scale up their product, to get their product further in market. What advice do you have to entrepreneurs who are obviously seeking funds in support of, product development? I'm sure you've seen a lot of things that work very well and probably, a little bit of things that sometimes don't resonate as strongly with investors. Any guidance that you'd offer to our founders on the product dev side?
Yeah, and for some context, I'm an early stage investor. I think Kirby's a click or two earlier than me, but in this crazy market, I'm investing pre-seed, seed, and Series A. Who knows what things are called anymore? But to give you a sense, about 50% of the stuff we've done is pre-launch and 50% is post-launch, which wouldn't have been the case 3 years ago, where most of it was already launched, product in the market, some early proof points. So in terms of raising funds, specifically around thinking about your product, the advice I would give founders is to have a very clear set of experiments and things you want to measure. So an example would be, okay, we're going to launch the product in February. We're going to launch it to the small beta. It's going to be, let's say, 200 people. And we want to learn these 3 things. I have a founder who basically said this to me yesterday. What gets challenging is if you're trying to do 10 things, 15 things. You're launching the product, you want to learn all of this thing, you're launching it to a really broad set of people. And what you risk then is spending a bunch of money launching it, not really getting a very core insight from it, and then having to do more and more experiments. If you as a founder can say, hey, I'm raising this much, let's say seed money, and over the next 12 months or so, I want to accomplish these 3 things. That's a very good way to share that story with a VC. And the 3 things, one of the things may be launching the product and learning XYZ. The other thing may be, hey, I need to hire an excellent COO. And the other thing may be, I want to expand from this first market that I'm in to one more market to show that my product or my service has expansibility and can go to a broader set of people. And if you can kind of communicate that well with the VC, then they understand exactly what they're putting money against. They understand what to expect, and they understand what you can hope to de-risk in that 12-month period before going out to raise the next round. The other thing that it does, I think it's really important for founders and VCs to have alignment. And it can create that alignment from day one. Okay, we agree these are the 3 things you're going to do. Let's check in quarterly or monthly, and let's make sure that we're all on the same page to accomplish those 3 things in the next 12 months.
Oh, that's so good. And I saw Kirby double thumbs up thing. So I'm assuming appreciating that sentiment and very strongly done. I want to double down on one thing that you said there, though, because I think it sometimes gets lost in translation. You talked about de-risking to get to the next round. Can you talk a little bit more about and the investor mindset when you're evaluating, do I believe this is a credible founder that's going to go do all of these things? And they're talking about scaling up and, becoming the next decacorn. What is it that you're really sort of trying to drill into as you think about de-risking the venture in your mind?
Yeah, so every stage of funding, think of it as a little bit more de-risking as you go along the way. So, early stage, it may be a person or 2 people and an idea. You're betting on them, their knowledge, their abilities, and you're maybe betting on, okay, someone in the market would probably buy this. That's probably going to change, but you're betting on the people, and there's a ton of risk involved. The entire market may change, a global pandemic may happen, one of the founders may quit. I mean, so many things could happen. And so you're trying to figure out what are the things that I can hold on to and feel confident about, and what are the big set of risks. At the next stage of funding, you want the founder or founding team to have de-risked a few more things. Maybe they've proven that there is a set of people who are willing to buy this product. Awesome. Now you've de-risked that. Maybe they've proven that they can hire a few really awesome people and surround themselves by great talent. Okay, you've de-risked a little bit more. And so as you inch along the fundraising path, you're de-risking more and more. Let's say you go into the growth stage. Well, hopefully many, many things are de-risked. You have a great product in the market, you're generating revenue, you have a strong team. At that point, the fundraising, the checks are bigger, the valuations are higher, but the investors then are also taking a lot less risk. And at that point, they're potentially getting less ownership because they are taking less risk. So they're putting their necks out there a little bit less. And nowadays things are changing, and you're getting huge valuations in early stage. But that's generally the theory of de-risking along the way.
Yeah, I love that. That also, I think, helps the importance of the point that you made earlier around why it's good to have alignment on what are the things that your guys are going to go do in this relatively short time period to de-risk the venture to get to that stage.
And can I add one more thing there,
please.
which I think that there's also like something gets lost in translation, which is, and I often say this to founders, like not every company has to be a venture scale, venture path company, and that's totally okay. And sometimes founders are like, hey, I don't know if I want to grow from $1 million in revenue to 10 to 30 to 100, and that's totally fine. But I think it's really important that founders understand the kinds of outcomes VCs need and the kinds of leaps we need in revenue or traction or whatever you want to call it, and that that pace is very demanding. It's very hard, and for founders to know that they're signing up for that.
So good. So good. All right. I've got time for a couple more questions, and then everyone keep that Q&A populating because we're going to get to those real soon, I promise. Craig, I'm going to start by sort of flipping things back to you for a second. So many of our founders, first time or otherwise, fundraising, it's a full-time process, a full-time job. You are giving so many pitches all the time. There's a lot of worry about, am I giving away too much information in these pitches? And a lot of uncertainty. We know generally, broadly speaking, you're not going to go off and sign NDAs when you're pitching VCs. So how do you coach and comfort entrepreneurs with this worry of like, am I giving away too much information? Where's the delicate balance? How do I think about sort of protecting my role as a founder and the IP that I'm generating as well?
Yeah, I mean, it's a great question because you really do have to strike the right balance. And Nicola, you're absolutely right. The vast majority of venture capital firms will not sign NDAs. They just see too many companies and they can't be bogged down in lawsuits. What constrains VCs from stealing your ideas, number one, they're not in the business of starting their own companies for the most part. They want to fund entrepreneurs, so they're looking for entrepreneurs, not for ideas. And there's reputation, and word gets around. If a VC gets a reputation for talking to entrepreneurs and sharing business plans with portfolio companies that they're working with in the same space, word will get around, and they'll have a tainted reputation, and entrepreneurs won't want to meet with them anymore. So I can't recall the last time I saw an issue with a VC actually doing anything inappropriate with information that they received from a founder of a company. That being said, there are a couple of things that a founder ought to do to protect themselves. The first is doing a little bit of research first about who you're talking to. Look at the fund's portfolio to make sure you aren't pitching to a venture fund that's already invested in a direct competitor. The vast majority of VCs will say up front, if they get a plan from somebody who seems to be in the exact same space as one of their portfolio companies, you know what, I think you probably don't want to talk to me because I represent X. And are you sure you really want to talk to me? And the founders will then generally back off. But it's better if you've done that research yourself, because it's kind of embarrassing to not know that a fund that you're reaching out to has invested in a competing company. And then secondly, you ought to be providing information kind of in layers. Everyone talks about peeling the layers of the onion. There are all kinds of metaphors or cliches about slowly releasing more and more information. But start your initial conversations with the high level, big picture of what you're doing. The first conversation, and a potential investor is going to make a decision about whether or not to meet with you based on the big idea. They don't need to see what's in your patent. And particularly if it's a patent application, you need to be super careful about not disclosing anything that's in the patent application and isn't yet public. So make sure that you're talking to an IP lawyer about what's okay to disclose. But generally, until you're at the very end stage of the process, in diligence, after you have a signed term sheet, the investors aren't going to dig super deep into your own intellectual property. So stage the disclosure.
Thank you. Such good advice and such words of comfort, we hope, for founders that are, trying to navigate that and a little bit worried or unsure about how to tread. Okay, we started the conversation out with Happy New Year because we all agree that we can still say that today. So this is my last question to the panel, and it's this: what are you most excited about or optimistic about this year as it relates to venture, or any specific industries or any specific things going on with your funds? Would love to sort of have the panel go around, and then we're going to do one final key takeaway, and then we're going to go into Q&A. So that's the roll up for right now. Kirby, you want to start us? What are you excited about for this year?
Well, I'm excited that the venture capital markets generally lag the public markets by 2 years.
I'm with you, my friend.
So, the clock may be ticking, but I'm excited that there's a lot of capital that needs to be deployed into great companies, and that's wonderful for our portfolios, and it's wonderful for value creation. I think in all seriousness, I'll go back to it. I'm just really, really excited about the entrepreneurs that are coming out of this last 5-year run of value creation. I mean, to Craig's point around the venture as a class of investment doubling year over year. There are just so many companies that have gotten fueled up and been able to grow just exponentially. When you think about a decade ago when I was doing it, $1 billion valuation was very rare, and companies grew fast, but the blitzscaling and hypergrowth were kind of outliers, and now it's just par for the course. And so, especially in markets like Seattle, which where I think we're the number 4 or 5 venture market in the country, and we have 2 multi-trillion-dollar tech companies in our backyard. We've always had a lot of really good technical talent, but the thing I'm the most excited about right now is that this value creation means that there are growth leaders, there are sales leaders, there are strategy leaders and finance leaders and operations leaders who have taken companies from kind of 20 people to 2,000 people, and from 10 million in revenue to 100 million in revenue, and that experience crossing over into the company formation ecosystem is just incredibly exciting. So that's a trend that I've seen really crack open in the last year, and excited to see more of it this year.
Very cool. Nargia, what are you excited about?
Yeah, I couldn't agree more with Kirby. I feel like +1 to everything Kirby said. I'll add on to that, which is I think we're at this amazing cultural behavioral shift in this country, and frankly in the world. With the Great Resignation, you're seeing people really pick their heads up and say, why don't I pursue my own dream? Why don't I build my own thing? And the level of entrepreneurship and company formation and innovation is just incredible. And the numbers that Craig shared are showing that. The fact that we're no longer asking, hey, could this be $1 billion company? And instead asking, can it be a $10 billion company? I think the recent term is a dragon, which is a $12 billion company. Who knows? But the ceilings have just gotten higher, and the opportunities have gotten higher. And when I was graduating college, there wasn't this obvious of go work at a startup. It was just starting to pick up. And now it's like, don't go to college, go work at a startup for many, many people. And I think it's just a really incredible time. And I think the whole 2 years of pandemic, all of the doubts around what do we do, what do we not do, has created a sense of almost a positive unrest, kind of an energy where people are like, I want to go do something. I want to go build a better healthcare system. I want to build better education system for our kids. And all these things that were kind of cracking started to emerge, and people are really thinking about how to make them better and how to empower the country should something like this happen again, or to move forward in a new age where things are more digital and people are demanding better of the communities and institutions around them. So I think we're in for a really exciting time, and I have my eye on a few companies and a few categories that I'm excited to invest in this year.
Oh, I love the rise of the innovators' contributions. That's so good. All right, Craig, round us out. What are you excited about this year?
Yeah, I would echo everything Anargia and Kirby said. There's just this entrepreneurial energy right now at a level I've never seen before. And this circles back around to our New Year's greetings to start this call. In the first 2 weeks of this year, I've received more phone calls and emails from really high quality entrepreneurs who want to incorporate a new company than I've ever seen in my career. And I think it's all part of the great resignation, as Anargia mentioned. I think people are saying, I see that there's an example of entrepreneurs who are successful, and this is the time for me to do it myself and start my own company. So these are the kinds of things that last for a long time. Even when the market suffers its inevitable downturn at some point, the people who are starting new companies right now are going to be around, and the people who are tenacious and persevere are going to build more great companies. So it's a great time to be an entrepreneur.
Great time to be an entrepreneur. Well, speaking of great times to be entrepreneurs, I'm going to launch one last quick poll in front of everyone right now. As a reminder, if it's your first time joining us, first, welcome. But we build programs, events like these based on what you tell us you need. We don't actually have a prescriptive approach to what we put on every month. It's up to you to tell us what you need. What's keeping you up at night will now inform our incredible program team at the center over the next 8 weeks to go find programs, events, classes, workshops that can get you unstuck from the challenges you might be facing and back to building the businesses that we need you to be building for the improvement of our communities and our world, as you just heard our panelists talk about. So thank you for helping to shape that conversation. Thank you for sharing with us transparently what you need. And we promise you, in all earnestness, we will take this information, reflect on it, and get the classes that you want over the next couple of months coming up. I'm going to end that poll, share the results really quickly. And as I do, I'm going to pepper the question to this to start with. Crowdfunding. Has it impacted, has it affected the ways in which you look at deals coming in? Are you seeing crowdfunding showing up more frequently in the early formation stages? Kirby, maybe I'd start with you, but Anargia equally would be curious, and Craig, from your perspective, has crowdfunding been making a mark in the ways in which early stage capital is going into our companies?
I haven't seen a ton of it. When I do see it, it tends to be for consumer products and hardware, which we do consumer. We don't do a lot of hardware. And I'll speak for myself. Like it's not. I don't love it when a company has, unless it's crushing it. And even if it's crushing it, the challenge is a lot of times companies will raise money from like a Kickstarter, but they actually don't fulfill the product on that money. So they raise the money to build the product, but then they only get halfway to building the product. And now they're raising money from me to go pay for a bunch of product that they already sold. Mm-hmm. So like that's a gotcha. And I've seen it happen more than once. And so there's a little bit of stink on it for me, but also very, very narrow sample size. So I'd probably defer to others.
Yeah, no, appreciate that. Nargia?
Yeah, I mean, same, not really seeing a lot of crowdfunding stuff. And I would actually say that the angel round has kind of been rebranded the crowdfunding-ish. There's a ton of angels out there just from the wealth creation over the last few years. And the angels are becoming more and more institutionalized. And so I'm not seeing like Kickstarter and those types of crowdfunding initiatives prior to coming out for a VC round, but I am seeing like a couple $1 million in angel rounds. I'm sure Craig is seeing that on the legal side as well, but angel rounds are becoming highly prevalent and quite strong.
Yeah.
I'll go further than Kirby and Anargia. I hate crowdfunding. And I'll give you an example. Yeah. And if you don't need to raise money ever again beyond your first fundraising, you just need to raise $2 million through a crowdfunding platform, whether that's Kickstarter, where you're raising money for a project, but it's not really an equity investment in your company, or whether you're going through AngelList or one of these other platforms. I think that can work very well. But if you intend to raise venture capital to follow, it really creates complications. I have a client right now that's buying a company that we discovered after the LOI was signed had raised a large portion of its money through crowdfunding. 4% of the company is owned by 285 individuals who invested $150 to $500 each using their credit cards through an online platform. And it's just a mess to deal with. And they're all direct shareholders. They're not holding as a group through a special purpose vehicle. And so my client has said, if you want us to buy the company, you need to make those people go away. You figure out how to solve it. You need to cash them out. But we're not going to buy a company in a stock for stock deal where we end up with 285 little investors who are not accredited or not sophisticated and are going to be sending us emails every 3 days asking how the company is doing. It's not manageable.
Wow. All right, well, let's move to the other interesting conversation that often showed up last year, SPACs. We had some pre-submitted questions around what do we think is going to be happening in the wide and wonderful world of SPACs this year? Any thoughts on the appetite of it? Any thoughts on whether or not the velocity is going to continue, Craig? I'll start with you just because you're sort of get some of that access intel.
Yeah, I mean, we saw, our firm basically would not work on a SPAC deal until about a year and a half ago, or maybe a little bit more than a year ago, that SPACs were considered for dreg companies that could not succeed otherwise. And it was truly a sign of desperation if you had to do a SPAC deal. And that really changed temporarily, at least last fall, when a lot of very high quality companies started looking at doing combinations with SPACs in order to become public companies. But due in part to the SEC taking a closer look at this huge growth in activity over the last year, and due in part to just market perception and market performance, most importantly, we've definitely seen a significant slowdown in SPAC activity or de-SPAC activity. There are plenty of SPACs being formed and still raising money, not as many as before, but still at very high levels. But we've got hundreds and hundreds of SPACs that have gone public and are looking for target companies right now. And I think that's going to be one of the real challenges over the next year to 2 years. These SPACs have a 2-year clock ticking in most cases, where they have to either find a deal or unwind and return the money to their investors. And there aren't enough targets to go around. And there's been a major correction in the valuations. The valuations were frankly bloated in these deals, and that's reflected in the aftermarket performance of a lot of the SPACs after they found their target and combined. So it's going to be a fascinating time. There are billions and billions and billions of dollars out there trying to find a target company. And the 2022 is going to be the year where some deals are going to get done, but a lot of the SPACs are just going to have to unwind.
It'll be an interesting one to watch for sure. Okay, time flies. It always does in these great conversations. So before I let you all go, other than saying a massive thank you, really incredible insights today, what is the one piece of advice that you would love our founders to sort of walk away from today? I'm going to go round robin on my screen, which means I get to start with Anarghya. Anarghya, what would be the one piece of advice you'd like founders to leave with today?
This is a very tactical piece of advice, but I see this happen time and time again. You as the founder know everything about your business. You know the ins and the outs. Oftentimes I see founders forgetting that when they're pitching VCs. Remember to bring the person along your journey, help them understand. It may not be obvious to them, connect with them as a person. At the end of the day, they as the person are going to decide whether or not they want to invest. So really connect with them and make sure that they understand what you're building, why you're building it, and why you are super advantaged to build in this space. And I'll end with a thank you to founders. I mean, we're in this business because you're doing what you're doing. What you're doing is really, really hard. And so always grateful for the amazing founders out there.
Oh, I so love that. Thank you. Kirby, over to you.
Fundraising is not a sales process, and you will never sell an investor on investing in your deal. So you need to explain what you're doing, who you are, why you're doing it, why now, all those things that you can research online about how to tell a story. But you just you're in the room or the Zoom, and your only job is to tell the story and make it clear why you're doing what you're doing and why it matters. And you can't convince an investor, once they've heard that story, like that investors will, there are ways to certainly like trigger investors positively to lean in, but it's never a sales process. And I think that's something I made a mistake when I was a founder. I tried to run it like a sales process, and it's just not.
So good. All right, Craig, round us out.
So I would say it's all about two things, tenacity and perseverance, I think are the two big nouns. That this, being an entrepreneur in an early stage company, is a roller coaster ride, and you're going to have great days where wonderful things happen and you get a term sheet and you raise some money, and you're going to have terrible days where a co-founder quits, or a co-founder, people start threatening. You have all sorts of, issues hiring people. Things are always going to go wrong, and you just have to keep fighting through it, because it is not easy. If it were easy, you'd take your job at a telecommunications company and sell cell phone plans. This is hard, and the rewards are big because it is hard. You're taking a big risk.
So to our tenacious founders who persevere on the good days and even more on the hard days, thank you for joining us. Thank you for letting us be a couple of minutes over for the incredible panelist training. Honestly, it's been such a treat. Thank you for sharing your time with us, your insights, your perspectives. And founders, we've got one last ask for you. Please take a moment and share your feedback with us today. Not only is it a huge gift that helps us plan better for future events like this, but it also allows us to double down on areas that you may have seen come up lightly today and want to learn more about. Thank you again to our incredible sponsors, and to everyone, we will see you soon. Take care. Bye-bye.